Hey guys, welcome back to the channel. I hope everyone is doing okay. Hope everyone is having a good weekend so far. So it looks like the market is trying to rebound a little bit, and let's hope it continues, but you just never know what could happen in the markets. So for example, we have the FOMC meeting this Wednesday, and people might think, oh well, since they're gonna cut interest rates, the market is sure to rebound, right? But this could be like people are building up their positions now, and then they might actually dump when the actual news happens. So just be careful of that. 'Cause there's a lot of these games that the markets like to play, so just be careful out there. So I've been getting like some questions regarding tourist erosion, and I'm hoping I was able to answer everything to everybody's satisfaction. Because I guess it's not like a very like obvious issue. And just as a matter of disclosure, I still have some high yield exposure via the ETFs, and now, but I am also starting to move some of my money into like just to do it yourself using like the underlying ETF and just using the options myself because I think that helps take some of the pressure off my portfolio and also off of these ETFs as well. So I just want to thank Rob O'Toole and just like some viewers in general for asking the questions because I think it could help other high yield community members understand the issue. Could you explain the tourism in detail maybe once? Like how does it actually lose money when people come and go from the fund? Is it just people taking the yield and not reinvesting? Thanks, Panda. Well, that could be part of the issue, which is, but I mean that's the whole point of like these ETFs that people can actually find a way to kind of live off of like their investments, especially if you're retired. So people have the right to get their distributions out and then use them to pay off like their living expenses. So it's not so simple as to like for example, if you and I we're buying these ETFs, like why should we reinvest like part of the distribution back into the ETF? I mean, the whole point is that we can take it and do whatever we want with it. So I don't want people to feel like you're obligated to put money back in. I think this should be managed in a way that I guess like maybe just like pay out the whatever you're getting from the cover calls, or maybe like the cash secure puts. Maybe that could be one way, and then maybe hold a little bit in reserve just in case like people want to cash out. This way it doesn't interrupt like the operations of the fund. But maybe that's just me. Yeah, I guess people can do whatever they want. But I hope maybe this example might help people understand like the problem, especially for people that like to learn visually. So let's say I create like a crazy ETF, like the high yield Panda excrement ETF, and of course this is a fake ETF, so don't go run out. I mean, you can't buy it anyway. At least I don't think there's a HYPE ETF. But anyway, let's say like the assets start off at 1 million, right? Pretty simple. And the share count starts off with 50,000 shares. So in case you don't know, I think most people know anyway, but like in general, like for any fund, it's just in order to calculate the net asset value per share, it's just your assets divided by the share count. So in this example, you take 1 million bucks divided by 50,000 and you get 20 bucks per share. So pretty simple, I think. But let's say like maybe some time later, maybe like a week, there's a big investor, Mr. YOLO, and he apes into hype, right? So ideally, the assets in the share count should grow at like a similar rate. So in this example right now, so let's say Mr. YOLO, he takes his net worth, and then he takes out like a full margin loan, like whatever his max is, and he takes that and just dumps it into this ETF. So assets go from 1 million to 2 million, so that's a double. And then the share count goes from 50,000 to 100,000, also a double. So if you do the math again, you take 2 million divided by 100,000, and that gets you back to still per share on a per share basis, it's still 20 bucks. So no harm, no foul. So far, there's no issue, right? Well, let's fast forward a little bit, some more to maybe let's say another week. But Mr. YOLO is also like a big time social media peddler, right? So he also has his ShowTube channel up. Maybe he also has like his FinTalk thing going on, and he shows like hype on his social media accounts. Okay, so let's go from 2 million to 5 million because like all his fans and followers and whatnot, they also start like dumping their a good chunk of their life savings into this fund, and then the share count goes from 100,000 to 300,000, and this is where you start seeing like some of the problems potentially with some of these ETFs, is that if the let's take from 2 million to 5 million, that's the factor of 2.5 times. But if you look at the share count, now it's actually at a faster rate. It actually triples. So if you do the math now, you see it's 5 million, but this time it's divided at like 300,000. And that gives you to like a value of like 16,067 cents. And I purposely made this number a little bit exaggerated, but it's not too far from the truth for some of these funds, because like the ETF issuer, let's say in this case is me, I'm not gonna care, because all I care about is like my assets is growing, so I can take like the expense ratio. That's how I get paid as an ETF issuer. So if I'm a little bit careless, or maybe like it wasn't, or maybe I overestimated like the demand, that this could potentially happen to certain ETFs. Like ideally, again, if it doubled from, well, actually, let's do the math this way. So the assets went from 2 million to 5 million, so that's like 2.5. So ideally, the share count should really be like 250,000 instead of 300,000, so that your net asset value should actually be 20. But in real life, like ETF managers have a lot to worry about. Like they have to actually manage the funds, so sometimes like it's hard to estimate exactly how many shares that should be issued. So I don't want to totally blame them too, but now you're starting to see like how stuff like this can happen. But let's make things even worse. So let's say like at the the FOMC meeting, Jerome Powell, like he farts into a hot mic, and then the market freaks out for some reason, along with Mr. YOLO and friends. And then Mr. YOLO and friends, like maybe they're new, or they're just panicking for some reason, and they just start like dumping like their shares in mass. So now you have a huge problem. So you have like the net assets is going from 5 million to 800,000, and then you also have like the share count like decreasing, but not at like a sufficient rate to kind of like catch up like the net asset values per share. So again, like now you see like kind of like on the flip side, where it's like when the assets and share count, they're not going down at the same rate, that this can cause like crazy problems. So in this case, like it's really dramatic. It's like 800,000 divided by 150,000 shares, and that gets you down to like a net asset value of $5.33. So even if I have like a high crazy like payout, like like maybe I do like some like special dividend, just because, let's say $10, right? And even if you add back like the distribution, like 10,000 plus like the $5.33 net asset value, that still only brings you up to like 15.33, which is still less than what you started off originally at, which was $20. So now you can see like from both sides, like the kind of like assets coming in and now like assets coming out. And I hope like again, like these numbers are made up, and like they're kind of exaggerated, but like, again, certain funds are not that far off from this example. So let's just say like the next week after that, like the markets calm back down, right? So you go from $800,000 back out to like a respectable 2.5 million, because people are calming down. The market is not panicking as much anymore. But then you notice like the rate of change in the assets versus the share count. Again, the share count issuance and redemption in real life, it should be better than this. But again, when you have like crazy back and forth, like money coming in and out, it's hard to forecast exactly how much you should redeem. Because let's just say like it's pretty crazy, because like that's why like some of these ETFs, like the cash levels are like kind of highish, because like they have to make sure they have enough cash in case like people panic again, and take money out. You don't want to like sell off like the actual assets themselves. Like let's say for example, this is a covered call ETF. I don't want to sell off like the stocks because then that causes like a capital gain or or a capital loss. And then it just like makes like the forecasting like just like the management of the assets themselves like that's already like a big headache, and now you have to also manage like the share count as well, or at least like be aware of the share count, and maybe it's like you like the ETF issuer, uh usually like the creation and redemption, the process is done by like authorized participants or like market makers, but that's another thing. It's just important for us as like individual investors to kind of be aware of this particular issue, because sometimes it's not the manager's fault, or like the you can't blame the market. It could just like be us as well. So yeah, again, in this case, like the rate of change in terms of like, the assets is not enough, or is like not at the same rate. So again, even if there's a recovery, so let's say from it's back up to 2.5 million divided by 200K, that only brings you up back to like a net asset value of 12,050 cents, in terms of share count. But again, using my other example, let's say I did like some crazy high distribution, you add back in the $10. So 2250 divided by $20. In this case, it just happens to be like you're still ahead, but you had to kind of like go through like this whole crazy process of, you know, maybe there was like tourists like coming in, and then like sometimes like they come out at like a faster rate, and then the ETF, the for the creation of the share count, it's not at like at the same pace, and that's how like sometimes like sometimes you see like, hey, how come my sometimes you might notice like how come the market is up but my like the my shares aren't going up at like the same rate, and this is why, or at least part of the reason why. So in this case, like the market's recovered, but the ETF hasn't been able to catch up. Now, of course, like this is a pretty crazy example, but let's look at a real life example. So Ulti had like quite a few issues. I made a video like how come like Ulti is so faulty, and I go through like they had like changes from like the actual structure. So they went from like normal cover call to like synthetic cover calls, and then like had like these like high cash level and then like a low cash level, and all this kind of stuff. So it's a combination of things. I wouldn't necessarily blame any one group. It was just like the perfect storm of like craziness. Like you had like just like underlying manager performance. Sometimes some of the stocks that they chose were just like all over the place, and then also like you had like people like hyping up the fund, and then people like just aping in, and then subsequently like people are aping out. So I just wanted to give you the latest numbers for Ulti. So this is as of September 13th. So the fund itself, if you just look at it, like you went from 2.4 million, and then that's a nice increase to 191.5 million. So assets went up, very respectable, 7,879%. And then like the share count unfortunately went up at a much faster rate. So 125,000 all the way up to like 17.2 million shares. So you can see like the share count went from 13,660%, which is a lot higher than the 7,800%. And then to kind of show you like the impact on the share price itself, it went from 1920 back to like around 11,013 cents. But of course, like it depends on when people bought in and when people sold out. So there's like a small number of folks that were able to get out at like like a small profit, depending on how low you bought and then when you got out. But unfortunately, not everyone was that lucky. So from February to September, even if you add back in like the high distribution rate, which was 6,087 cents. So you add 6,087 cents back to 1113, that only brings you to what is this? 18,010 cents, which is still lower than what you originally paid. So in this case, it's on the face of it, it's not that bad. But when you compare it against like if you just like stuck it in like the SPY ETF, you would have been better off. So unfortunately, in this case, it wasn't enough for positive total return. But in recent videos, like NVIDIA just happened to be like another yield max ETF that, surprisingly for its size, it doesn't have that issue, which is pretty amazing. So I don't want people to think that it's going to be like a like a serious problem for every ETF. You kind of have to go through the numbers for each one, or at least like the ones that you currently own, and just kind of keep track of it that way. I think that might be better for some folks, because there's a certain, I guess, like a game theory to this too, because like there's different participants. So for example, like something like the Roundhill, or like the recent changes to the YMAX and YMAG ETFs, like those, like that do like a weekly payout, those might be better for like longer term investors. But you have to also keep in mind, if people keep like aping in and out, that could cause like serious issues for long term investors. So just I just hope everybody's cognizant of that. And then also, kind of on the flip side, like let's say you're a young person and you're just like trying out. I know that like it's investing might be tough on certain points because there's a lot to learn, and then you want to try before you buy. Don't let me scare you out of this. I don't like when I say tourist, I don't mean that in necessarily like a derogatory term, because let's say you're only buying like 100 shares here and there. That probably is not gonna impact anyone, unless like everybody has like the same idea and start aping at the same time. This is why I say, like, you don't have to like kind of rush into everything. There's no need to like over leverage and like YOLO your entire net worth in any one thing, because that's going to cause like distortions, like as you can see. You're going to cause like either a cash drawdown for the ETF, or like we even have to like resort to selling off some of the long option part of like the portfolio if it's a covered call ETF, and that forces, like, it's kind of like a forced redemption, like you're selling off your base just to meet redemptions. And that's not fair to other people that are just trying to live off the proceeds from like these ETFs. So I don't mean to be preachy, because like people can do whatever they want, but you have to kind of watch like the impact. So I think it might be helpful for just in general, like if you pace yourself. For example, if you want to just like dollar cost average, so just like take it easy, because you want to kind of watch like for your kind of like your market impact, especially if you're a larger investor, and like you don't want to. Maybe like it's better to like test the waters and kind of spread it out over time, and then this way, like it gives like the ETF managers like one less thing to worry about. So anyway, so hopefully this was easier to understand. And of course, this is just my opinion, which doesn't really matter if you think about it. But I just want people to stay on top of their investments and your hedges in general, and just please watch out for yourselves. So if you like this type of content, please consider giving this a like and subscribe. So I really appreciate the support. Thank you for watching. I hope people make some good money and sustainable money out there. So I'll see you in the next video. Bye now.